Due to COVID, there's also a possibility that if you qualify, you could take money out of your 401k or IRA up to $100,000. This is part of the CARES Act, and this would avoid the 10% early withdrawal penalty on one of these accounts. You also have the option to spread the taxes out on this distribution over 3 years, and you may have the ability to repay the loan within 3 years.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. Unfortunately, I've been reading in some of the local papers that layoffs have been taking place at different industries across the U.S. as we continue to struggle with COVID. And I thought now would be a good time to talk about what to do if you find yourself in the unfortunate situation of being laid off. And, first thing is to definitely take a deep breath and try to stay calm as best you can. It's certainly never easy when you lose your job. It's a big change, but there are things you can do to make sure you're on the right footing. And definitely connecting with family and friends, talking with them about what's going on can be helpful. Also communicating with your spouse and your children about what's going on so that everyone's on the same page can be very helpful as well. So you want to address your budget and see what things you can eliminate now that you don't have income coming in. Are there expenses that you have that could be reduced, such as maybe entertainment expenses? Could you possibly downsize to one car? Could you eliminate maybe monthly subscription services that you have? Just taking a hard look at your budget and figuring out what things can be eliminated. And hopefully you've put together an emergency fund that you can tap into. It's definitely a good idea to have at least 3 to 6 months of an emergency fund in a checking or savings account. But if you don't have that set up, there's other options that you have to turn to, which we'll talk about in a little bit. Any debt that you have, it's a good idea to reach out to those creditors to see if you can pause your payments. Right now, due to COVID, a lot of lenders, especially mortgage lenders, are giving you the opportunity to potentially put your mortgage payment on hold for 3 months and either make the payment up later on or just have it get added on to the back end of the mortgage. So it's a good idea to reach out to if you have a mortgage, your mortgage provider, and if you have car loans or any credit card debt, to reach out to those companies as well and see if there's anything they can do to work with you. If you're renting, it may also be possible for your landlord to adjust the rent that you're paying. Landlords many times want to keep tenants, especially if they've been good tenants, and possibly delaying the rent a month or two or maybe reducing the payment could be an option as well. And chances are that you're going to be eligible for some type of unemployment benefits and maybe even some severance. So you want to get an idea of what it is that you have coming into you and try to set as much of that money aside as you can in case you're not able to find employment when that runs out. For unemployment right now, you'd go to your state's website and you'd file for unemployment. There was an additional $600 per week that was being given out for people on unemployment due to COVID, and that might still be going on. If not, then it's possible another round of stimulus might be passed and that could be reenacted. Next, you really have to think about your health insurance. How are you going to maintain health insurance? You have a few options there. One is that if you had existing health insurance through your employer, you can maintain that through what's known as COBRA, and generally you pay 102% of the actual premium versus prior to that, your employer might have been paying part of that cost. So it could be much more money than you were previously paying if your employer was paying a substantial amount of the total premium. So you want to at least find out how much that is and make a decision whether you want to continue down that route. You can keep COBRA for up to 18 months, or another option is because you've had a triggering event, you could enroll in another health plan through your state's Affordable Care website. And in Connecticut, it's accesshealthct.gov. And from there, you could see what plans are on that website, and you could possibly convert your health insurance into one of those plans. But if you've already met your deductible for your existing health insurance as we're getting towards the end of the year. You may want to just maintain that at least until the end of the year and then set things up to go into a different health plan after the beginning of the year. Another option is that you can get a plan completely off the healthcare exchange. You can get a plan where you're not getting any benefit through the exchange, and that might also be appropriate if you're looking for a plan maybe with a higher deductible or maybe a plan that is going to give you a lower premium. This could make a lot of sense if you're in good health. So if you're in a situation where once your unemployment or severance runs out or your emergency fund and you need access to money, one place you can turn is your retirement accounts. If you're over 59 and a half, then you don't have to worry about the 10% penalty when withdrawing money from an IRA. If you do have money in your 401k and you get separated from the company between 55 and 59 and a half, you also can take money out of that 401k and not pay the 10% penalty, but distributions from either account is going to be taxable provided that the money in those accounts is pre-tax, as most 401k and IRA contributions are. And additionally, if you have money in a Roth IRA or Roth 401k, that's another way that you can withdraw money, and you can presumably do this in a tax-free way. As long as the 401k or the IRA meets the 5-year holding rule, which means from the date of the first contribution, it's been 5 years and you're 59 and a half, then there's no penalty or taxes on what you can withdraw from your Roth 401k or your Roth IRA. But if you're in a situation where you don't meet that, you can still take out your contributions first as a tax-free distribution, and it's only once you've exceeded your contributions in withdrawals that taxes or penalties could apply. Another option is that if your current 401k still allows you, they may allow you to take out a 401k loan and pay that back. Generally, those loans have to be paid back within 5 years, and you're also paying yourself back interest. But this is another way that you could also get money out, and with those loans, they are not a taxable distribution. There is a limit, however, of half of the account up to $50,000. You also want to think about any other benefits you might be losing due to this layoff, such as group health insurance, group disability insurance, or group long-term care benefits. For group life insurance, it's probably a good idea to look into getting your own individual life insurance policies. That's something that's easily done. And this would also help you in the event that a layoff occurs again in the future and you don't have a lapse in coverage. For long-term disability, it could make sense to get your own individual policy, though it might be more expensive and more difficult to secure than a group policy. And for group long-term care, that's something that you might be able to continue, and that might make sense from your previous employer, or you might want to look into getting your own. Due to COVID, there's also a possibility that if you qualify, you could take money out of your 401k or IRA up to $100,000. This is part of the CARES Act, and this would avoid the 10% early withdrawal penalty on one of these accounts. You also have the option to spread the taxes out on this distribution over 3 years, and you may have the ability to repay the loan within 3 years. You need to check the eligibility rules for this, as they have slightly changed since the original exemption came out. But as defined by the IRS, you need to be a qualified individual, which takes into account someone who was adversely impacted either by coming down with COVID or by being the spouse or a member of one's household who was impacted by COVID. The CARES Act defines a qualified individual as someone who is being quarantined, furloughed, or laid off due to COVID, was unable to work due to lack of childcare, there was a closing or reduced hours of a business owned or operated by you, if you had a reduction in pay or self-employment income or work hours, or having a job offer rescinded or a start date for a job delayed. So you want to check into this to see if you could qualify for this exemption. If you happen to be eligible for a pension from your previous job, then you should investigate what your options are with that pension. There might be the ability for you to take a lump sum payment on your pension. That could be a way to access some money in the short term. You also want to find out if you're going to take the monthly payout on your pension, when you could start that and what the amounts would be, and whether or not this could begin now or you'd have to wait until a certain point, such as maybe when you reach age 65. If you're not quite at the point where you can retire, then you want to think about your strategy as far as getting back into the job market. And, some of the things that obviously you'd want to do is update your resume. If it's been a while since you've had to put together a resume or your existing resume is quite out of date, make sure that you put together a resume. You do some research on the best way to make your resume stand out. You may also want to get some tips on the best way to present yourself in an interview, preparing for an interview. And as far as looking for jobs, obviously networking with previous coworkers or people that are in your industry is always a good idea. Using LinkedIn, there's a number of tips out there. If you don't have a LinkedIn account, you probably should open one. It's a good idea to put a professional picture there, as people are more apt to accept a friend request from you if they know it's you rather than not having a picture. And also looking at your other social media accounts to make sure they present a professional image, as a lot of times companies will look you up on these websites and you don't want to give them the wrong impression. You could also look outside your previous industry if you think that other industries maybe have better hiring opportunities than the industry that you came from. And it's definitely not easy to find another job after you've lost one, but keep looking, as you never know when opportunities might present themselves. I hope that you found this episode helpful on what to do if you find yourself in the unfortunate situation of being laid off. If you'd like to learn more about how I could help in this situation, you can go to retirewithryan.com or morrisseywealthmanagement.com. Have a great week, and I'll talk to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.